This meeting is being recorded.
All right, welcome back to Principles of Accounting 1. I am still your host, Dr. B. Happy to have all of you with us. We made it to the second week of the fall 2024 semester here at UDC. And first of all, I want to start by thanking all of you for your efforts in that first week. I know it was a really short week. We started on Wednesday, ended on Sunday. And yeah, it's really, really fast. And so I apologize for that. I think that the university would be better off if they started the semester on Monday. But for some reason, they like to delay that first week. And that just kind of drives me a little crazy, but that's just me. If you had not had an opportunity to complete that first week because maybe you joined the class late or you missed a few items like the LinkedIn Learning Certificate, please do your absolute best to get that first week work done as soon as you possibly can, because I need to report your attendance to the university, and because we do not record attendance in the class, the only way for you to be marked as attended is to complete work during that first week. So, having said that, please make sure you complete the week 1 discussion, the LinkedIn Learning Certificate, and the Chapter 1 quiz. Those are the 3 things that you needed to complete this past Sunday. Most of you were able to do that, and I thank you very much for your efforts. And for those of you who have not yet completed all 3 of those items, please make sure that you do. You'll notice that it's important never to skip anything in this course because of the way that the points are distributed across all of the work. So please, again, really important that we don't fall behind. So let's make every effort that you can. If you ever run into trouble, please contact me. Okay, I am here for you. I am here for your success. It is really, real important to me and to you that you do well in this course. Okay. Along those lines, I was able to reach out to the bookstore. I talked to the manager. I talked to the people at McGraw-Hill, and we got the textbook situation fixed. So if you were having issues accessing the textbook before, please give it a try again today. It should be up and running. So for you to do that, all you need to do is go to the Start Here menu. You'll select the Brightwave Course Materials, select the Brightwave Course Materials button. Either one of those will bring you to the same place. And it should, in theory, should open up just like this. This is the textbook for this course. It is Fundamental Accounting Principles, and it should be right here. You might need to do some logging in or whatever using your UDC credentials, or maybe you received an email from the bookstore, but however it works, I just want to make sure that you have access to this book. If for whatever reason you're still having problems accessing the book, I know Denario had some issues before, just want to make sure we're good now. As long as we can access this book, we should be okay. Yeah. So again, if you're having trouble, just please reach out to me via email, and I will get you connected with the bookstore manager and we'll get it fixed. So hopefully it's working now. Just want to let you know what's going on. Okay, so here we are in week 2. We finished week 1 last week, this past Sunday. We're now in week 2, which started yesterday. Ideally, before each week begins, it would be good for you to at least review the content, the materials before we have our lecture, so that we can come with questions. But if not, that's also fine. I just wanted to show you how the week is laid out. We have our week at a glance, shows you an overview of the information we're going to cover today and the things that we need to do for this week. You'll notice under the instruction materials, we got a couple of things for you to look at. The instruction materials will open up like this. We have the PowerPoint presentation that we're about to cover. You can download those or you can view those, whatever you feel comfortable with. They're there for you to use. And then we have some additional content. We have this really cool thing called a ThingLink. It's just an interactive way for you to help to engage your learning process. And so you'll click on things like this and it'll have little pop-ups. It's just really cool stuff. And then there's a couple of short videos that, again, just reinforcing videos from LinkedIn, just kind of help your learning process. And then for this week, we have a week 2 discussion board related to the fundamentals of the accounting equation. And we also have the chapter 2 quiz. You'll also notice for almost each week, there's this thing called Excel exercises. This is just for practice. Excel is just for practice. It's not graded, but it is here to help you to learn a little bit more about how to use Excel in accounting. Yeah, that's the idea behind these practices. The Excel files are just for practice, okay? What is graded this week is the week 2 discussion board and the chapter 2 quiz. So for this week, by Thursday night, you should have your original discussion board post and responded to classmates by Sunday. And by Sunday night, have your chapter 2 quiz complete. Remember, each quiz in the course, you have 2 attempts to earn the highest grade possible. So out of the 2 attempts you take for the quiz, the highest of those 2 attempts will be accepted into the grade book. So 2 action items, discussion board and your chapter 2 quiz. Without further ado, let's go ahead and jump into today's discussion, and that is on how to analyze and record transactions. Last week, we had the opportunity to discuss and explore the accounting equation, if you recall last week's discussion. And we talked about very general how accounting works in business. That's what last week was all about. And one of those key concepts is the accounting equation. Does anyone in the room today remember the accounting equation? Can anyone tell me what is the accounting equation? Feel free to type it in the chat or unmute your mic. What do we got?
Is it assets equals liability and equity?
Yes, thank you, Tanika. Very well done. Yes, the accounting equation is assets equals liabilities plus equity. Can anyone tell me what is an asset? What is an asset?
Cash.
Cash, yes. What else? What else we got?
Something beneficial to the company.
Beneficial to the company. So, how? Tell me how.
So it could be like financial. It could be physical, like a certain land that the company owns.
Yeah, exactly. You nailed it. You just said what it is. It's what the company owns. It's beneficial. It helps the company generate revenue, right? So we got land, we got buildings, we got equipment, we got cash. What else we got?
Accounts payable.
That's a liability. You're on the other side of the accounting equation.
Accounts receivable.
Accounts receivable. Yes, receivable. Remember, an account receivable is when the customer owes us, the company, money, right? That we own a claim to that revenue that the customer hasn't paid us yet. So account receivable is an asset. Yep. Accounts payable.
Equipment and supplies.
I'm sorry, go ahead.
Equipment and supplies.
Yes, equipment and supplies. And when we talk about supplies, I want you to think about inventory. Supplies is technically inventory. Inventory are the things that the company sells. It's the goods the company sells to the customers, yeah? Inventory. The book calls it supplies, okay? Yeah, awesome. Very well done. Yeah, so those are all assets. What about liabilities? What's a liability? Members, what's a liability?
Loans. Any
Loans.
loans you take out.
Yep, loans. Well done. Absolutely. What else?
Accounts payable.
Accounts payable. Accounts payable is when the company received a bill but has not yet paid it. Company received a bill, has not yet paid it. That's accounts payable. Well done. What else? Liabilities. Loans, accounts payable. What about mortgage payable, wages payable,
Auto loan.
taxes payable, anything with payable in it, right? That's a liability. Yeah, exactly. Very well done. Okay, what about equity? What's equity?
Revenue.
Revenue minus
Stock.
expenses equals net income. What else? Equity.
Stocks.
Stocks. Yep, absolutely. There's also an account called paid in capital. That's the funds that the owners invested into the business to get it up and running. Paid in capital. Yeah, very well done. So so today we're going to talk about those types of transactions in a lot more detail that go into the accounting equation, right? We're going to talk about things like the businesses selling maybe services or inventory to the customers. We're collecting cash from the customers. How do we record that? So we're going to go through how to analyze and record those transactions. We're going to go through a lot of examples. So let's do it. Let's have some fun with it. So in accounting, when we have a transaction, there's two sides of it, right? There's two accounts that get affected in every single transaction. I'm going to show you what all that looks like. So first, what is an account? The idea of an account is that it's a part of a transaction. Okay, every transaction has two accounts that are affected. And we talked about this last week, right? We talked about the importance of keeping the accounting equation in balance. And that's what we're going to dive a little deeper in today. So, couple of things. Business transactions, we consider those economic events. Yeah, all it means is that something happened. There was an exchange for something, right? I sold the customer some inventory, they gave me cash. That's an exchange. I reduced my inventory, I increased my cash. Yeah, that's an exchange. That's a transaction. Okay? And these transactions, they affect our accounting, our financial statements. They affect the income statement, balance sheet, statement of cash flows, and ultimately a statement of retained earnings. So we go through a process to identify, record, and analyze these transactions. And we post them and record them and analyze them. Tanika, I see your hand. Please, Tanika.
Yeah, so I had a question about that, what you're explaining right now. I don't know how to calculate all of that stuff. I was so confused. I was like, okay, I'm gonna need a deeper explanation for this.
Yeah, absolutely. And so I'm glad you asked that, Tanika, because what we're going to do here shortly, after we talk about the stuff like the basic financial statements and the source documents, etc., I'm going to walk you through a bunch of transactions, and I'm going to show you how they're calculated. Okay, because there's not like a, how do I want to put this? All of the transactions that we went through last week, you saw how they affected the accounting equation, and we saw how the total of assets, liabilities, and equity was always in balance. We saw how assets always equal liabilities plus equity, and I'm going to show you how we go through those calculations and what everything looks like when it's all put together. And I'll do my best to make it make sense for you. But yeah, that's an excellent question, and thanks for bringing that up. So yeah, Tanika, we're going to go through a bunch of examples, so don't you worry. I got you. So
Thank
you're very welcome. My pleasure. So these are the steps that we take. The first thing we do is we identify the transaction. What happened? We identify it. And the way we identify that is we look at these things called source documents. I'm going to show you what that is next. The second step is we analyze the transaction using the accounting equation. Say, okay, well, is this affect my assets, liabilities, and equity, or liabilities or equity? What's going on here? So we're going to analyze each transaction. Then we record it to this thing called the general ledger. In this general ledger, we record the transaction, and then it gets that transaction posts to what we call our ledger accounts. I'm going to show you what that looks like. And then the last step of the process is to prepare and analyze the trial balance and the financial statements. So those are the steps that we take for every transaction. Now, of course, in today's modern technology, we don't do this one by one. I mean, it's just, that would take forever. It's the process is a lot easier when we use things like QuickBooks or Excel or some type of accounting software. But it's important that you know how to do it, from a manual perspective. So that way, when you're using something like a QuickBooks or whatever, that it's correct. And so if you're doing it yourself, you know if the system's going to be correct or not. Yeah. So I had mentioned about source documents. Source documents are the original documents that help us to identify the transactions that have occurred. These type of documents include things like our bills that we received that we put into our accounts payable. Yeah. When we put it into accounts payable, that means we've received the bill and we've recorded that expense. For example, I received my Pepco electric bill in the middle of August, and that bill represented the electric that I consumed in the month of July. Okay, July 1 to July 30. And it says, okay, this is the amount of electric you used. This is how much the bill is for, right? So what I do is I make what I call a general journal entry, and I date it for July 30 because the electric was consumed in July. Date it for July 30, and I debit utilities expense, electric, for the amount of, we'll say $250, and I credit accounts payable $250. What that does is it increases my expense, utilities expense, and it increases my accounts payable. And I got that information for that transaction from the bill. See how that works? That's why the source documents are really important. Other examples of source documents would include things like sales receipts, sales I made to my customers over the month. I got all my over the day. Let's say we're running a grocery store. We work at a grocery store. You know how at the end of I've worked at a grocery store. I don't know if any of you have, but when I used to work at a grocery store, at the end of my shift, they would say, "Hey, print the tape from the cash register." Okay, so I'll print the tape, meaning it would print like all of the sales that I made for the day, for that shift. And I would tear it off and it would have the total at the end, and it would tell me how much cash I received, how much credit cards were processed, etc. for that day, for that shift. That's called a sales receipt. Okay. And so what I would do is at the end of the night, you collect all the sales receipts and you make a general entry into your accounting system, and you would, go through a process of like debiting cost of goods sold and crediting sales. That would help to increase your sales and increase your cost of goods sold on the accounting system. Checks are another source document. We receive checks from our customers. We receive checks from other people, or maybe we're paying checks. The checks is another example of a source document. It has a lot of information like the date, who's paying or who was paid to, the amount, and so that way we can properly match it in our accounting system. Purchase orders is when the company is purchasing some inventory maybe from a vendor. And so the way it works is we would issue that vendor a purchase order, And then later on, we would receive the inventory based off of the purchase order. I ordered 5 units of this, 10 units of that, 20 units of that, and it would be on the purchase order. I would send that to my vendor. The vendor would then ship me what I ordered. And with that order, with that shipment, there would be this thing called a packing slip. And the packing slip would be in the box, and I would open up the packing slip. The packing slip is also considered a source document. I would match the purchase order with the packing slip, verify that what I received is accurate and correct, count it all out, and then I would record that in my counting system. I would increase my inventory quantity and increase my accounts payable. Yeah, so I'll debit inventory and credit accounts payable. Payroll records, another example. I have to pay my employees. Yeah, it's kind of the law. So sometimes a company might pay you once a week or once every other week, sometimes twice a month, depending on who you're working for, right? And so every time that you get paid, there's a payroll record associated with that payment, right? So the payroll record shows how many hours the employee worked, what the hourly rate is, or if it's salary, what that salary rate is, and then that would be what we call gross pay. And then also on that payroll record, we would see all of the deductions, yeah, state tax, federal tax, Social Security, and Medicare, and then any other deductions, right? And then at the very end, you would have what's called net pay, and that would be the amount that you would receive, right? So that's a payroll record. And so as an employer, I have to record those payroll records into my accounting system in order to track my payroll expense, you see? And also it helps me to track how much I owe to the tax agencies for the payroll taxes. Yep. And then the last example we have on this list is a bank statement. The reason why a bank statement would be a source document is because I would receive the bank statement and I would match the amount of cash that the bank statement says to the amount of cash I have in my accounting system, make sure it's accurate. And I would add in any type of fees or any type of NSF fees or whatever, right? To balance out, to match my bank statement with my accounting records. So those are all just a few examples of source documents that we would normally see in accounting. The very basic of an account is this. An account is a record of increases and decreases for a specific asset, liability, equity, revenue, or expense. As we just talked about when we started the class today, assets are the things that the company owns: cash, accounts receivable, notes receivable, inventory, prepaid accounts, supplies, equipment, building, land, etc. Those are individual accounts, right? And so we record the transactions to those accounts. The general ledger is a record of all the accounts and their balances, just like we have on the balance sheet. So this just kind of shows you what an account is and how we track those balances. So one of the first things we do is we analyze, right? So here we go. This is what we just talked about just as the class was starting. Our asset accounts are what the company owns, right? It's the resources owned by the company, owned and controlled by the company. And just like Denario said, it's for the future benefit. It's for the benefit of the company, yeah? So those are your assets: cash, accounts receivable, notes receivable, inventory, prepaid accounts, supplies, equipment, building, and land. And the list can go further than this, but this is just, these are assets of a company, okay? Very general general assets. Sometimes a company might have more than this or less than
I
that.
have a question.
Yeah, go for it.
So when we, in last class when we were doing the equations and we had the questions at the end of the session.
Yeah.
So, well, actually, I have two questions. But how important is it to analyze each asset under like the equation, how we were doing it, if you get what I'm trying to say?
I do. Yeah, it's really important. And the reason
So
for
you
that,
have to organize it that way?
yes. And,
Okay.
and the reason for that, great question. It's a great question. The reason why we have to classify each account rather than just lumping them all together is that we need to be able to track what's happening in each account. So the reason, here's an example, Zara. So here's an example of this. Let's say that our company has equipment, a building, and land. Okay, or we just have equipment as one of our fixed assets. Equipment, buildings, and land. Well, equipment and buildings, they depreciate in value. What I mean by that is, over time, these things wear out. It's just like a car. Okay, let's say you have a car. Let's say you bought a car brand new, and then over the next 5 years, that car is going to wear down. Okay, it's normal. It's a machine. Anything mechanical breaks down over time. Even if you take care of it, you change the oil, you do the regular maintenance, it's still going to break down. Why? Because it's a machine. That's what they do. As the machine gets older, it loses its what we call useful life. It loses its value over time. That's why when you go to sell your car after it's used, you can't get as much for it as you could when it was brand new. You see what I'm saying? So because of that, we need to keep these things separate because our assets are not always going to be the same or treated the same way, if that makes sense. So that's why it's important that we keep track of the balances of all of our individual accounts. So does that help to kind of clarify that question for you?
Yes, I understand. Thank you.
Hey, my pleasure. Yeah, excellent question. With liabilities, as we talked about, those are what the company owes to someone else, and the equity accounts are what the owners own. And this all relates back to what we talked about last week. Diving a little bit deeper into our assets, as I had mentioned, and all of these you already know. Cash, property, plant, and equipment, also known as land, buildings, and equipment. Accounts receivable, notes receivable, prepaid accounts, and supplies. Maybe the one that you hadn't heard before, or maybe you have, there's two of them. Notes receivable and prepaid accounts. Here's what these are. A note receivable is when we had a customer, here's the example. We have a customer who owed us money. They used to have an account receivable, okay? And they didn't pay us on time, right? They didn't pay us within the 30 days. And then they didn't pay us again another 30 days. So they're past due. What do? We contact that customer and we say, hey, listen, we're going to convert your account receivable into a note receivable. What that does is it attaches interest, fees, etc., okay, onto their account. Now we basically turn their account receivable into a loan to us. Yeah, that's what a note receivable is.
Is that similar to like collections?
Yes, that's exactly right. So for example, I've been there. You forget to pay it. All of a sudden, it's like blah blah blah. You start getting letters and all that. It's just like collections, yeah. And they're saying, hey, not only did you owe us that original balance, now you owe us the additional interest and fees and whatever. So yeah, that's exactly what that is. The company itself, we call it a note receivable because it's collections to us. Yeah,
Mm-hmm.
great question. And then the other one's called a prepaid account. A prepaid account is when we prepay something. Here's a couple of examples. Every year, I pay 12 months of my insurance up front. Why? Because I get a discount. Okay. So that they'll say, hey, if you pay for the whole year, it'll be a lesser amount. Cool. So I always do that, you know. That's called a prepaid account. I prepaid it. I paid it in advance of the expense happening. Okay. Here's what I mean. Let's say our insurance is $1,200 for the year, and I prepay it. It starts January 1, ends December 31. Okay? I prepay it in December for the following year. When I do that, what I'm doing is I'm prepaying the expense. As the year goes on, the prepaid amount goes down because it's moving from prepaid account into the expense account that it belongs to, insurance expense. The reason why a prepaid account is considered an asset is because I can go ahead and cancel that policy and take that money back, right? Because that's still my money. I gave it to the insurance company in advance for the year. If I cancel it in February, they owe me the remaining 10 months, you see? So that's why it's a prepaid account is considered an asset account. And the other ones we know. I just wanted to explain those just because I don't think we've heard those ones before. Now, moving to the other side of the accounting equation on liabilities, as you know, we have accounts payable and notes payable. Here are two other ones maybe we haven't heard about yet. One is called accrued liabilities. An accrued liability are amounts owed that are not yet paid. Amounts owed that are not yet paid. That's why we call them accrued liabilities. Here's an example of this. I have an employee that works for me, and I pay my employee every 2 weeks, okay? I don't pay them every day. I pay them every 2 weeks, okay? So what that means is my employee is accruing their wages. They're building it up. They're accruing their wages. At the end of that 2 weeks, I pay the wages. You see, it's a liability to me because my employee's working for me and I haven't paid them yet. It's a liability to me. So wages payable is an example of an accrued liability. Okay. The other one you probably haven't heard of yet is called unearned revenue. Unearned revenue is a liability that is settled in the future when a company delivers its product or service. Here's what this means. Here's an example of it. I have a lawn mowing business. Okay, I mow lawns in the neighborhood. And I go to my customers and I say, hey, pay me for the season up front. Okay? And I'll mow your lawn for the season. When the customer pays me for the season up front, that's called unearned revenue, and it's a liability. Why? Because I have not yet mowed their lawn. When I mow the lawn, it becomes earned revenue, which is an equity account. You see how that works? It's unearned because I didn't I didn't perform the good of the service. The customer could always contact me and be like, hey, you know what? Just give me my money back. That's why it's a liability. You see? You get it? That's
Yes.
yeah, so that's unearned revenue. So those two, I just want to make sure to clarify because I don't think we talked about those yet. Now moving down the accounting equation to our equity accounts, we have 4 common equity accounts. One is called paid-in capital, also known as owner's capital. This is when the owner invests money into the business. We also have what's called owner's withdrawals. It's when the owner takes money out of the business for personal use. Yeah, if it's a sole proprietorship or a partnership or a whatever ship, the owner has the ability to take money out of the business. It's their business, So when the owner takes money out of the business, they're reducing their equity. And then, of course, we have our revenue and expenses. Revenue is what the business earns from selling goods and services to their customers. Yeah, that's revenue. Sales is what that is. Yeah. And then expenses. These are day-to-day operating expenses of the business. Utilities, rent, wage expense, office supplies, repairs and maintenance. These are all expenses. List goes on. That's just a very short list of expenses. It's a very long list. But that just gives you an idea of what the equity accounts have. Now let's break down that looking at our equity. Let's break it down a little bit further to figure out what is total equity. Because sometimes it's difficult figuring out the totals, right? And Tanika made a comment earlier. How do I know what the total is, or how do I calculate this? Well, this is one way we will calculate total equity. We take the owner's capital investment minus withdrawals plus revenue minus expenses. That would give me total equity for the company. Now, sometimes there might be a question on, let's say, a quiz or whatever, and it's like solve for X, right? So if you think about the accounting equation, let's say I need to solve for equity. Okay, I don't know what equity is, but I know what my total assets are. How can I solve for equity? Well, remember the accounting equation, total assets equals liabilities plus equity. So if I know my assets are and I know what my liabilities are, I can figure out equity. I just take my assets minus liabilities to find equity. You see? Remember, like the basic math thing when we change the sign. What I'm trying to say is we can rewrite the accounting equation to solve for X. So I could do assets minus liabilities equals equity, right? That's how we would solve for equity. It's just a matter of changing the sign when we put it on the other side of the equal sign, yeah? So if you ever run into a question where it's like, oh, solve for, what is total assets? Well, if I know what liabilities total is and equity total is, I know what asset is because assets equals liabilities plus equity. You see what I'm saying? So it's just a matter of, sometimes it's just a matter of changing the equation to solve for X. We talked about all of the different accounts, assets, liabilities, and equity. Now it's time to talk about what we call the chart of accounts. The chart of accounts is a way that we organize all of our individual accounts. We can see that it goes in order, in a logical order. For assets, we organize our assets in the order of which they are most liquid. We organize our assets in the order of which they are most liquid. What that means is how quickly I can convert my assets into cash is how it's organized. You see, that's what liquidity means. It's how quickly I can convert something into cash. So what that means are how do I organize my assets? we always start with cash. Cash and then accounts receivable, inventory or supplies, prepaid insurance, and then we will go property, plant, and equipment. You can see that it's pretty easy for me to convert accounts receivable into cash because customer going to pay me. I can somewhat easily sell through my inventory. I can somewhat easily get my prepaid insurance converted back to cash. However, it's a lot more difficult to sell property, plant, and equipment. So assets are organized by order of liquidity. For liabilities, it's organized by current and non-current. A current liability is something that we owe within the next 12 months. A current liability is something that we owe in the next 12 months. Current liability. The word current in accounting means something that is owed in the next 12 months. So current liabilities would include things like accounts payable, unearned revenue, wages payable, taxes payable. Those are current liabilities. Long-term liabilities means that we pay on it for more than 12 months. That would be something like notes payable, mortgage payable, car loan payable, the stuff that we pay on more than 12 months. And then equity is organized by equity. we have our paid-in capital, then our withdrawals. Revenue is always revenue, and then our various expenses. You'll notice that all of our accounts have a little number next to them. That's just how we organize it in our accounting information system, called an account number. Yeah, very simple. But that's what a chart of accounts is. It's a way we organize our accounts in a logical way. So now that we talked about all of our different types of accounts, let's talk about this next thing called double entry accounting. As I mentioned, every transaction affects two different accounts. And when we record our transactions, we're affecting two different accounts. Each account has a visual representation in what we call a T account. All a T account is it's a visual way to see the balance of that account. For an asset account, we know that if we debit an asset account, we increase it. If we're reducing an asset account, we credit it. So an example of this is where it says account title, we would put something like cash. To increase cash, we would debit the amount. To decrease cash, we would credit that amount. And then I would do something similar for the other account that's affected by that transaction. That's why we call it double entry accounting. Let me show you a little bit. This slide is great. I love this slide because it shows me in a very general sense the effect on the accounting equation. Assets equals liabilities plus equity. To increase an asset, we debit it. To decrease an asset, we credit. When it goes to the other side of the sign, the equal sign, it flips. You see? So to increase a liability, we credit the liability. To decrease it, we debit it. And the same for equity. But you already know that equity is more than just the total. Remember? We talked about this. In equity, the expanded version of equity is we have the paid-in capital, owner's withdrawals, revenue, and expenses. So that's why this slide is probably more important than the last one, because I can see the expanded part of the equity section. To increase paid-in capital, I credited it, and I debit it to decrease it. The opposite is for owner's withdrawals. To increase my revenue, I credit it. And to decrease my revenue, I debit. And then to increase your expenses, you debit them. To decrease an expense, you would credit it. Usually we don't decrease expenses, just so you know. But this just kind of shows you the expanded version. I really like this slide. I would use this one as a reference slide. Yeah. Let's give you an idea. Okay, so here's that example I was giving you earlier with the T account. Here's cash. This is our cash account, and we can see how our cash account was affected over a month, I guess. It'll say this is a month. So here we go with cash. Well, remember, when we increase cash, we debit, and to decrease cash, we credit. So here I can see that the owner invested $30,000 into the business. We received $4,200 from consulting services that we provided to a customer. And we also collected $1,900 from an account receivable. So that's money coming into the business. We collected $36,100 during the month. We also made a lot of payments for various expenses in cash. So here we go. We purchased some inventory, $2,500. We purchased some equipment, $26,000. We paid rent, $1,000. We paid our employee, $700. We paid an account payable, a bill, $900, and the owner took out $200. Okay, so on the left side, we debit, cash going up. On the right side, we credit, cash going down. You see? And then at the end of the month, we see our balance. What's our balance for cash end of the month? $4,800. We take the debit amount minus the credit amount. That gives us our balance. So that's just a visual representation of our cash account. And you might be thinking to yourself, man, these numbers look familiar. Yeah, that came from the last chapter, right? From the first week. So every transaction that we get in, we have to record it and analyze it and post it to the financial statements. Remember that we have to go through those steps. First thing we do is look at the source documents. We analyze the transaction based off the source documents, how it's going to affect the accounting equation. The third step is we record the transaction. And the fourth step is we post it to our general ledgers, or our ledger accounts. And then from there, it goes on to our income statement, balance sheet, statement of cash flows, and statement of retained earnings. So in recording a transaction, I look at a couple of key pieces of information. The first key piece of information is the date. Why is the date important, you might be wondering? Remember that electric bill example I gave you? I received my Pepco bill in the middle of August. It was for the month of July. The consumption of electric for July. I dated that transaction July 30. The reason why that was important is because that consumption was in the month of July. And according to the matching principle that we talked about last week, I need to match my expenses when they were incurred, when it happened. So that's why the dates are really important. So first thing I look at is the date. Second thing is, what are the name of the accounts that are being affected? So what's my debit account? Then I look at what is my credit account. I make sure the amounts match up. And then the last thing I do is I write a little note, what it was for. Okay. So here in this example, we see two transactions. One was on December 1, one was on December 2. First transaction is the owner invested $30,000 into the company. So we debit cash, $30,000 to increase cash, and we credit paid in capital, $30,000 for the owner. Cash is clearly an asset account, and paid in capital is an equity account. The accounting equation is still in balance. Second transaction, we purchased inventory or supplies, $2,500. We debit inventory, supplies, $2,500, and credit cash, $2,500. Our inventory went up, our cash went down. They're both asset accounts. Accounting equation is still in balance. Hopefully you remember some of these transactions from the past week, but it's just kind of we're reiterating. I'm showing you how to record them. So what happened with our cash account over those 2 days? The cash went up on December 1, it went down on December 2, and then there were 2 other transactions that happened. But you can see that on my ledger account, my T account here, my balance goes up when I debit cash, goes down when I credit it. And I'm recording the balance as it's changing, you see. So that's what it looks like. At the end of the month, whatever that balance is, it'll be the same balance that you'll see on your balance sheet for cash. So I record the transaction. When I record the transaction, it's being posted to my ledger accounts. Okay, in real life, it's very automatic, especially when we're using something like QuickBooks. So going through the process, first we identify the transaction in the source documents, then we analyze the transaction using the accounting equation, then we record the journal entry, which is recording the transaction, and the fourth step is we post it to our ledger accounts. So here we go. Let's roll through a bunch of transactions. The first one, we already talked about it. Owner is investing $30,000 into the business. Okay, so we analyze it. What's the effect? It's going to increase assets, increase live equity. I'm going to debit cash. I'm going to credit paid in capital. Then that gets posted to the ledger accounts. So steps 1, 2, 3, 4, you see. So that's the first transaction. Second transaction, we purchased supplies for $2,500. So what's the impact? Cash goes down, inventory goes up. So I record the transaction. Debit inventory $2,500, credit cash $2,500. It posts to my ledger accounts. You see? Third transaction. I'm purchasing equipment for cash for the amount of $26,000. My cash is going to go down by $26,000. My equipment account's going to go up by $26,000 in both our assets. Debit equipment, $26,000. Credit cash, $26,000. Post those to my ledger accounts. The fourth transaction, I'm purchasing inventory on account or on credit. You'll always hear me say on account. On account means accounting. On account is probably going to be accounts payable or accounts receivable. Anytime you hear the words on account. So here we are, purchasing inventory on account or on credit. I'm going to increase my inventory and I'm going to increase my accounts payable. Debit inventory, $7,100. Credit accounts payable, $7,100. You'll notice that when I post those to the ledger accounts, my supplies or inventory account is going up. So is my accounts payable, it's going up. Remember, accounts payable is a liability. Fifth transaction, I am receiving cash for providing consulting services to my customer, $4,200. Okay, so cash is going to go up, so is my revenue. My debit cash, $4,200. Credit consulting revenue, $4,200. And then I post those to my account. You'll notice that on the cash balance, you see transactions 1, 2, 3, and now 5, how they affect the cash balance. Transaction 6, I paid an expense in cash. I paid rent. Okay, so cash is going to go down, rent expense is going to go up. I debit rent expense $1,000 to raise my expense. And I credit cash $1,000 to reduce my cash. And we can see again the effect on cash. Transaction 7, I'm paying an employee $700. Cash going down, salaries expense going up. I debit salaries expense $700, credit cash $700, also to the ledger accounts. We can still see the effect on cash. Transaction 8, I provided consulting services and I rented some equipment or facilities to a customer on account for the total amount of $1,900, $1,600 for consulting, $300 for rental revenue. On account, when I provided it on account or on credit, that means that it's an account receivable in this case. I billed the customer, they haven't paid us yet. So I'm going to debit accounts receivable, $1,900, so much the customer owes us. And I'm going to credit my revenue, $1,600 for consulting, $300 for rental revenue. Now, Zaire might ask, well, Dr. B, is it important for us to separate the revenue accounts? The answer is yes. Yes, it's very important. And the reason for that, Zaire, is because as a business owner, you need to be able to track where your revenue is coming from so you can analyze the performance of your business. Yeah, that's why it's important. And sometimes there might be different tax rates. Other reason. I just want to let you know, just in case you were thinking about it. All right. Then we post those to our accounts. Transaction 9, we received cash from our customer who owed us the $1,900. Good, they're paying. That's good. We're going to increase cash and decrease their account receivable. So I debit cash $1,900 and I credit accounts receivable $1,900. Remember, accounts receivable and accounts payable, those go up and down with the level of activity. So for the account receivable went up when the customer owed us the money. I have to reduce their account receivable when they pay us. You see what I'm saying? That's what that means. Transaction 10, a partial payment of accounts payable. We decided to pay our vendor $900 for some stuff that we purchased from them. It's not the full amount, because I think we purchased more than that. Okay. So we reduce cash and we reduce our account payable. So I debit account payable to reduce the account payable. And I credit cash to reduce my cash. Now we post those to the ledger accounts. See where we're going with this, right? Transaction 11. The owner took out $200 for whatever reason. Okay? It's the owner. So cash went down 200 and equity for the owner went down by 200. So we debit owner's withdrawals 200 and credit cash 200. Now we post those to our ledger accounts. Transaction 12, we received cash payment for future services. Okay, here's this one gets a little tricky because it says future services. When something happens in the future, it's unearned. Okay, it doesn't become earned until we perform the good or service. So this would be unearned revenue. Customers paying us in advance for something we haven't done yet. We haven't provided the good or the service yet. Therefore, it is unearned revenue. So here we have the example. Customers paying us $3,000 for future services. Okay, so we debit cash, $3,000, and we credit unearned revenue. this case, unearned consulting revenue, $3,000. It becomes earned when we perform the good of the service. Then we make an adjusting entry. We'll talk about that in the future. Transaction, I gave this example earlier. And it's a lot of people do this. We're paying for future insurance coverage. The word future again. Future insurance means prepaid. We're prepaying. So I'm prepaying 2 years worth of insurance coverage beginning on December 1. I debit prepaid insurance, which is an asset account, $2,400, and I credit cash, $2,400. Remember, the reason why prepaid insurance is an asset is because I can always cancel that, and then they have to pay me back the difference.
I have a question about that though.
Yeah, go for it.
Like in terms of the company, if
Mhm.
somebody prepaid their insurance, you got the money that
Mhm.
they paid, but they canceled their policy or whatever. But you as the company, like say if I prepay Geico my car insurance
Yep,
and I decide I want to cancel the policy, they refund me back the money.
correct.
So why is that not a liability if it's coming out of their cash?
Great question. So for you, the customer, you prepaid the insurance, so it'll be an asset to you.
Okay.
It would be a liability to the company that you paid it to. You see what I'm saying?
Okay, thank you.
Yeah, you're welcome. No, good question. I'm glad. It's good to ask clarifying questions like that. Definitely, especially when something's a little confusing. Very well done. Thank you. Okay, so we debit prepaid insurance to increase it, and we credit cash to pay for the prepaid insurance. If I cancel that policy, then they would pay me back the cash. So in other words, for the insurance company that I'm paying, for them, it's unearned revenue. You see what I'm saying? Okay, we're purchasing some inventory in cash, debit inventory, credit cash, posted to our accounts. Here we are, we're paying an expense in cash. We got a utility bill, $305. We're just going to pay it as soon as we got it, okay? So we debit utilities expense, and we credit cash. We're going to pay another expense in cash. Now we're paying an employee. We debit salaries expense and credit cash. See? So that's a lot of transactions. We just went through 16 transactions. And that's why I like this particular summary slide, is because it shows us the impact on all of those individual accounts that we affected. So on the left side, we can see our assets: cash, accounts receivable, supplies, prepaid insurance, and equipment. All of those accounts were affected by transactions that we made. And we know that when we increase an asset, we debit it, and when we credit it, we're reducing it. So we can see that we had a lot of transactions that involve cash. So I take my debit total minus my credit total, and that gives me my debit balance. See? Accounts receivable, we increased our accounts receivable, customer hadn't paid us, and then they paid us, so we reduced it. Supplies, we bought a bunch of supplies. Apparently, we haven't used any yet. When we use the supplies, then that amount will go down. Prepaid insurance, we haven't used the insurance yet, so that's debit. And then equipment is there. We haven't depreciated that yet, so it has a debit balance. On our liabilities, we have accounts payable. Our accounts payable went up. Let's see. We On the fourth transaction, we purchased $7,100 worth of stuff on accounts payable. We paid a little bit of that later on. We paid $900. So that gives us an account payable balance of $6,200. Under consulting revenue, customer paid us in advance, $3,000. We haven't performed the service yet. When we start performing the service for that customer, then we'll reduce that amount. That'll be converted into earned revenue or just revenue. On our equity side, we have our owner paid in $30,000, took out $200, and then we have our revenues. Consulting revenue totals $5,800, rental revenue $300, and then we have our expenses. Salaries expense was $1,400, total balance. Rent expenses $1,000, utilities expense is $305. At the very bottom, you see that we total everything up. Assets equals $42,395. Our total liabilities is $9,200. Our total equity is $33,195. $33,195 plus $9,200 equals $42,395. The accounting equation is still in balance. But that's just an example of how we would find those totals, Tanika. That's how we get there. It's just a matter of going through the transactions, and we're watching the balances. Yeah.
But given technology, we're not doing all. You guys don't do all.
We
of
don't do this by
math.
hand, no. Oh no, we got
So
computers
it's
to do
like
all
some
that for
kind of
us.
equation. It's an equation you got to put on Excel or something to get it like this.
Yeah, so I'm glad you asked that question. So a lot of times owners like to make sure that everything's correct, and so
Mhm.
what we do, and I'm actually going to show you what that looks like in the next step, is we go through what's called an adjusted trial balance. The adjusted trial balance shows us if our numbers are correct, right? And so if we're going to use Excel for something like, we will probably use Excel for something like that, and so that's where it comes in handy. Yeah, great question. But yeah, for the most part, the accounting software that you're going to use in real life at the job, you might use QuickBooks or you might use Oracle or whoever. There's a whole bunch of accounting softwares out there. The software's going to do that stuff for you. You don't have to be manually entering everything. Yeah, good question. But to your point, we go through what's called the trial balance, and I'm going to show you what that looks like here shortly. So based off of those transactions, we prepare what's called the trial balance. And there's 3 steps to preparing this. The first thing we do is we list out all of our accounts and their balances. Then we compute the total debit amounts and the credit amounts for each account. And what we do is we verify or prove that debit total equals credit total. See, that your debits must always equal your credits in every single transaction. If they don't, something's wrong. And that's why we go through the trial balance. So here we have a list of all of our accounts and their balances. You can see that at the very top, we have all of our asset accounts listed out. Cash, accounts receivable, supplies, prepaid insurance, equipment. Those are all asset accounts. Remember, asset accounts normally have a debit balance. Asset accounts normally have a debit balance. And because of that, they should have balances in the debit column. Then we go to the other side of the accounting equation. Here we have our liabilities, accounts payable, unearned consulting revenue. Those are liabilities. And then we move further down the accounting equation to our equity. We have paid in capital, $30,000. And then we have withdrawals. Withdrawals normally have a debit balance, $200. And then we have revenue, normally has a credit balance. And then we have our expenses, salaries expense, rent expense, utilities expense. Those normally have debit balances. And as I have all my totals, I look at the very bottom and I see that 45,300 equals 45,300. I'm in good shape. There's no errors here. Okay, that's why we go through that exercise. And to answer your question, that's what we would normally do in something like Excel. And so that's why understanding how all of this works manually is really helpful for the business. So we're looking for errors, in accounting, we want to make sure that everything's correct because playing around with money here, y'all, so we got to make sure it's right. So we go through this process, these 6 steps to make sure that there's no errors. Verifying trial balance correctly added, making sure the ledgers are correct, debits equal credits. If there's an error, then we have to go back through and make it some type of adjustment wherever necessary. We'll talk about adjusting entries later on. I think next week we talk about that. The financial statements are then prepared from the trial balance. We can prepare our income statement, balance sheet, statement of cash flows, statement of retained earnings. The income statement, as you know, shows your revenues and expenses. The statement of owner's equity shows changes in equity. The balance sheet shows balances of all of your assets, liabilities, and equity. And the statement of cash flows shows changes of cash coming in and cash going out of the business for operating activities, investing activities, and financing activities. And don't worry so much about that right now because we'll dive a little bit deeper into the financial statements soon. This is an example of that income statement based off of those transactions that we had. We see our revenues here at the top and then all of our expenses listed out. Your total revenue minus total expenses equals net income. Net income is what's left over, and we can see that net income gets transferred onto our statement of owner's equity. It gets added to the total equity amount. Minus withdrawals equals ending balance equity. We can also see that equity, of course, the total balance equity gets transferred onto the balance sheet under equity. And here we see that relationship. On our balance sheet, we see cash, supplies, prepaid insurance, equipment under assets. Under liabilities, we have all of our accounts payable under consulting revenue. And then under equity, we have our total equity amount. And then if there's any issues, we make corrections. Presentation issues be like dollar signs not appearing or the periods in the wrong place, etc. And I can't let you go until we talk about one ratio, and that's the debt ratio. Debt ratio is used for evaluating risk. We take total liabilities divided by total assets. The higher this debt ratio, it shows that the company might not be able to pay its future debt. So that's why it's important. Okay, thank you all so very much for your time today. I really do appreciate all of you being here. As a fast reminder, what you need to do by Thursday night is post your original discussion for the week 2 discussion post. And then by Sunday night, 2 responses to classmates and complete your chapter 2 quiz. Any comments, questions, or concerns? We good? Okay. Thank you all so very much for your time today. I sincerely appreciate all of you being here. If you ever run into any trouble, just reach out to me. I'm here for you. Thank you so much. Have a wonderful rest of your night. Take care. Bye-bye.
Thank you so much.
Thank you.
Thank you.
Take care. Good night.
Good night.